Not all money is good money, and if you're raising capital for a real estate development project, you need to be just as selective about your investors as they are about you. I'm Josephine, founder of Sapphire Development Group. I've raised capital for multiple residential development projects, and trust me, who you take money from can make or break your deal. In this video, I'm breaking down the best types of investors to work with, the worst ones to avoid, and how to spot the difference before you sign that first check. Let's start with the good news. There are investors out there who will make your life easier, your deal smoother, and it's a true win-win. Here are the types of investors you actually want to work with. Experienced real estate investors. These are people who already understand the development risk. They're not expecting smooth sailing. They know timelines can shift and they respect the process and they won't panic if something does deviate. Long-term equity partners who really are invested in you and want to grow alongside with you make great investors. Those are the folks that don't just look for the quick cash. They're actually patient enough to also help you grow and you guys grow together. Development takes time, and if they're in it for the long haul, you'll have way less pressure and you guys make better decisions. Third, accredited investors who can add value. Yes, money is great, but also relationships, insights, and strategic introductions are even better. And don't forget about your peers. So other investors who can bring you deals, connect you with other lenders, also maybe just recommend a solid contractor. You want to make sure you foster your network. And finally, passive investors with realistic expectations. Investors who are happy to stay passive, trust the business plan you put out, and don't expect daily check-ins so there's no micromanagement. Those are gold. They're passionate working with you, they're engaged, but they're not trying to sit in the developer seat with you. When you surround yourself with the right investors, raising capital becomes a partnership and a long-term win-win. But let's flip the coin. What happens if you go with the wrong investors? They can derail your entire project, can make your life miserable. Let's talk about who to avoid. First, micromanaging investors. These are people who have watched a few HGTV episodes and now think they should be giving you design advice and questioning every subcontractor and process along the way. They'll slow you down, second guess your decisions, and drive you nuts, and ultimately can cost the project and you a lot. Next, investors with unrealistic return expectations. If someone expects a 50% profit in 6 months or wants guaranteed returns, just walk away. Development isn't a get-rich-quick scheme. You need partners who understand risk-adjusted returns, market volatilities, and who respect the reality of what we do. Third, high-maintenance friends and family. Taking on Linda's retirement check might sound like a sweet idea, but if she's going to call you every week asking when she gets her money back, it's not worth the emotional toll or risking your relationship. Emotional investors bring emotional baggage. You don't want to carry that into your project because it's going to just derail everything. And finally, investors who can't afford to lose their money. If investing in your deal would financially wreck them if things go south, they're just not the right fit. So focus on accredited investors. And believe me, that stress will seep into every single interaction and you'll feel it in the entire project. Taking the wrong investor's money is like bringing a bull into a china shop. Something is going to break and you'll be the one stuck cleaning it up. That's why vetting your investors is just important as analyzing the deal itself. Bringing in capital isn't just about getting funded. It's about protecting your project, your reputation, and your sanity. And I want you to sleep at night. So as a developer, it's your job to lead the deal and set the expectations from day one. In my experience, the best way to do that is be clear, be upfront, and be selective with who you bring in. Here are a few ways to protect yourself before you accept a single dollar. Have a clear investor packet and business plan. Be upfront about risk and realistic timelines. Don't shy away. Address them heads on. Ask them about their investment experience and also expectations. And make sure you watch how they respond to conservative projections. If they flinch, that's a red flag. And finally, trust your gut. I'm a very intuitive person. If someone feels high drama now, just know that it's going to get worse when things get hard. This is your project. You're building the team, so choose really wisely on who you want to have on that team. So let's wrap up. The right investors will bring you capital, patience, and perspective, and will be long-term win-wins. The wrong ones will bring drama, distraction, and unrealistic demands, and gonna make your life miserable. Raising money isn't about just saying yes to everyone. It's about finding the people who believe in you, believe in the project, trust your expertise, and respect the process. If you want my personal investor pitch template for raising capital, you can grab it in the description below. It will save you hours and make your next investor meeting way easier. And if you want more hands-on help, live deal reviews, deeper training, real-time support, check out Developer Academy. This is our coaching program with a full course, weekly group coaching, and an incredible community of real developers building real projects nationwide. If you like this video, I would appreciate it if you hit like, subscribed, and left a comment sharing what you've learned. And if there's anything you want me to cover next, let me know in the comments as well. I post videos every week to help you raise capital, build smarter projects, and grow your development business with confidence. Thanks for watching, and I'll see you in the next one.